Good afternoon. This is Anna Pinedo at Mayor Brown, and thank you very much for joining us for our webcast on understanding structured debt and private convertibles. Joining us, we have our friends from ICR Capital LLC, Raj, who's the head of convertible and equity derivatives advisory practice at ICR Capital. Raj advises clients on complex capital markets transactions, and he was previously a managing director at Barclays, where he focused on covering convertibles and equity derivatives. And Anna, who is a managing director in the convertibles and equity derivatives advisory team at ICR Capital. And Anna brings a unique combination of legal and banking expertise in helping clients on convertible and equity derivatives transactions. Anna was previously in various senior legal roles at Wells and at Barclays. So today we're going to be going through and discussing market trends affecting structured debt and private convertibles, which are very timely given market conditions, the volatility, the tightening markets, and the fact that in this market environment, many investors, particularly private equity investors and private credit funds, and choose often to invest through structured debt and through converts. For those of you that are seeking CLE credit for today's live session, the CLE affirmation form and the rest of the forms for CLE credit were sent to you with the materials for today's session. So during the presentation, at least twice, we'll be reading the CLE code. If you fill out the CLE code in the materials and send those back to the Mayor Brown address that's listed on the CLE forms, will respond with the CLE credit in due course. In addition, we'll be sending a copy of today's slides, and we'll be providing a link to the recording. So without further delay, I'm going to turn the presentation over to Anna, who's going to get us started.
Thank you, Anna. Do you want to go to the next page, please? Great. Before jumping into the details, we wanted to give you some color on what exactly we will be covering today. Convertibles can be issued by different types of companies using different marketing strategies and can be structured in a number of ways. Today, we'll focus on private convertibles issued by both private and public companies. To start, we should define what we mean by a private convertible. Here, we are not talking about the distribution method. For example, convertibles marketed in a 144A offering to qualified institutional buyers is legally considered a private placement. However, a 144A deal is often marketed to a broad group of convertible investors using a market standard marketing process. So in the banking world, we consider that to be a public deal. Here, by private, we're referring to convertibles with one or a small group of investors, where there's often a long marketing and negotiation period. But we will not specifically cover public convertibles. We will compare in detail the private convertible process with a typical publicly marketed one. For our session, we will look at both private deals for regular public companies, as well as private pre-IPO companies. As for conversion method, we will mostly focus on regular convert securities and not a mandatory security. Mandatory convertibles are rare in the private world, although we will spend a few minutes on pre-IPO convertibles that mandatorily get converted upon an IPO. Lastly, we will cover convertibles with both debt and preferred underlying instruments. Next page, please. Before we get deeper into our topic, it may be helpful for some to have a reminder of the simplified mechanics. A convertible is fundamentally a combination of a bond and an equity option. But the next few pages help you see what that really means by breaking it down into the cash and share flows and focusing on what happens at every step of the transaction. Just a warning that this is a simplified version of what can occur during the interim period. And we spend a lot of time with our clients educating them on everything from change of control and refinancing that can occur in between. Maybe a topic for our next panel. All right, let's say that you want to raise $100. Stock price is at 8, the coupon is 1%, and conversion premium is 25%. This means the conversion price is $10 and a $100 security has 10 underlying shares. 100 divided by 10 conversion price. Day one, you receive $100 and give the investors a convertible bond. In exchange, you promise two things. You will give the investors 1% annual interest and a maturity that will have a choice between receiving $100 and 10 shares. During the interim period, you will pay $1 of interest. Next slide, please. At or near maturity, investors have two choices: receive the $100 principals back in cash, or convert the convertible and ask for their 10 shares. Investors would generally opt for the 10 shares if stock at maturity is higher than $10. Depending on how you structure the convertible, you may have the flexibility to settle the conversion in cash or a combination of cash and shares instead of just shares. Please do note if you convert expires out of the money contractually, which you owe is $100. Next page, please. Now that we have the basic mechanics, let's consider why somebody would issue a convertible bond and how it compares with other options a company may have. Most of the following applies to both public and private convertibles, and I promise we'll surely get into the section where we compare them. So, compared to equity, no registration. With convertibles, you're also fundamentally selling the shares at a premium, which can be particularly attractive during times when valuations took a huge hit. And dilution in a convertible can be materially lower than for equity. On the negative side, a convertible is leverage on your balance sheet. It will be viewed as 100% debt by your creditors, as well as rating agencies, and you will have to repay it or refinance it at some point. Okay, let's compare to debt. A convertible provides significant flexibility compared to debt. No restrictive covenants, at least for public options. No need for rating, a quicker process. Of course, a convertible also has a much lower interest expense because of the embedded options. For public deals, similar to equity offerings, and unlike for debt deals, a convertible provides the ability to pick up coverage. We work with our issuer clients to build their syndicate and work with our investor relations team to maximize this aspect. However, compared to debt, convertibles can be dilutive. If you think your stock will grow 4 to 5 times in the next 5 years, convertibles will be quite expensive. Lastly, there's potential for stock price impact. Raj will cover this in detail a bit later in the presentation, and we spent a lot of time with our clients discussing this very topic. While convertibles are attractive for issuers, they can be attractive for investors as well. The biggest appeal for long-only investors is a downside protection while having exposure to the upside. For hedge funds, an appeal is to be able to monetize the equity volatility. Next page, please. Okay. Now let's talk about the basics of private convertibles, but comparing it with a public convertible. As the name implies, one is broadly marketed and one is confidentially marketed to only a small group of investors. As we mentioned earlier, even a 144A offering that is marketed to quips only is considered a public deal in the banking world. The marketing period and the process itself is significantly longer in a private deal. And in most cases, you may need 6 to 8 weeks to complete a private process versus only 2 to 3 weeks for a public deal. The marketing for the public deal takes 1 day and sometimes 2 to 3 days, depending on a wall cross, where the confidential marketing alone in a private deal can take 2 to 4 or even more weeks. We will discuss a timeline in detail later in the presentation. With respect to structuring, both options have a lot of decisions a company must consider, evaluate, and properly understand. However, in general, public convertible options are more standardized. The private convertible route offers greater flexibility, and both issuers and investors should carefully consider how to use this flexibility. For example, public convertible bonds always have cash coupon, whereas private convertibles often have a PIK option. On the other hand, since private structures are not standardized, depending on the situation, an investor may ask for incremental protection or value through security, warrants, covenants, and other features. Raj is going to go through some of the common toggles and structuring choices, and each of these will need to be considered and potentially carefully modeled. In terms of sizing, public convertibles have fairly standardized sizing metrics based on stock technicals and a couple of other variables. Many private deals are not strictly limited to stock technicals. What matters are the check size of the investor, the issuer's need for capital, and willingness to incur dilution. With respect to terms, the headline terms tend to be worse for private converts. However, looks can be deceiving because a private convertible is often priced on an overnight basis, and so the stock impact of a public deal can be avoided in a private convert. We have some examples to walk through a bit later. Next page, please. The investor base for private convertibles also tend to be more diverse. For public convertibles, it is generally long-only convert funds, hedge funds, and sometimes equity income funds. For private convertibles, you will see strategic investors, sovereign wealth fund, private equity investors, equity and creditor investment, hedge funds, and other special situation investors. For a bank syndicate, a public convertible process is actually more involved. It's depending on the size of the deal, it can include a large group of banks. We help issuers carefully work through the syndicate structure to maximize relationship growth and rewards. For private deals, there tends to be one or sometimes two banks. In fact, two of the deals we will talk about on the precedent page just had us as an advisor without banks because the deals were done through reverse inquiry and the companies needed assistance with valuation and structuring and not marketing. For call spreads, which are the options that help manage dilution of convertibles, those are pretty uncommon in private converts, although the recent global payment deal added a call spread after the deal. That does add complexity to the transaction. On the other hand, call spreads are very common in public converts, and they help with execution of the deal. With respect to governance, depending on the size and the percentage of the company the private deal represents, you can start seeing potential board seats given. In public deals, you will not see board seat or observer rights. Raj will speak through some other items that are found in private convertibles and convertible structuring terms on the next few slides. I'll turn it over to Raj now. Raj?
Thank you, Anna, and hi, everyone. Hanson, let's go to slide 8. Okay, so now that we have gone over the basics of a private convertible, let's dig into the key structuring terms. As Anna mentioned earlier, private convertibles are much less standardized than a public deal. And over the next 3 slides, we will cover the 15 or so key features of a private convertible. The first aspect is security type. Does the convertible security have a bond or a preferred as the underlying base instrument? This mostly depends on the issuer's cap structure, so covenants and need for ratings, and also the investor's particular desire to invest in the preferred format, perhaps due to tax or governance reasons, versus their desire for a stronger bond floor. Convertible preferreds generally have worse terms than convertible bonds, no surprises there. And depending on which path you choose, some of the next few sub-features may be moot. One such example is maturity. Convertible bonds will always have a dated maturity, 4, 5, 6, 7 years. Preferreds, on the other hand, can either be redeemable, so basically with a finite maturity or redemption date, or they can be perpetual. Longer dated or perpetual preferreds are much more equity-like, and rating agencies give issuers more equity credit, but the terms tend to be worse and many private investors don't like them. In both convertible bonds and preferreds, you can have issuer call rights. The call right does 2 things. It allows an issuer to call the bond early and repay them for cash, but The call rights can also act as a mechanism to force investors to convert. So imagine a situation where the security is in the money and the issuer exercises its call right. A prudent investor should not take the par amount and would rather convert the securities at a higher value. Issuer call rights are very powerful and beneficial for issuers. So as you can imagine, investors do not like this feature. These days in public deals, you will rarely see unrestricted call rights. In private deals, you may see issuer call rights, but investors ideally will want the non-call period to be as long as possible. And ideally, instead of an unrestricted call right, they will want to add a provisional call. So what is a provisional call? A provisional call is one where an issuer can call the bonds only if certain conditions are met. So for example, you can call the bonds only after 3 years and only if the stock trades 30% above the conversion price for 20 out of 30 consecutive trading days. Now, the numbers I just mentioned are the standard rules for public deals, but for private deals, the call period can start earlier, which helps investors. The call period can start earlier, which helps issuers, and the call trigger can be much higher, sometimes as high as 100% above conversion price, which helps investors. In either case, once the trigger is met, only then is the issuer allowed to call the convertible. At that point, the investor is going to convert the security, and that's exactly why this provision is really a forced conversion mechanism. Okay, investor put right. If investors require incremental credit protection or downside protection, they may ask for an early put right or even a springing maturity ahead of another debt maturity. The put or redemption price can be at par, but depending on the minimum IRR target of the investor, it can be set at a premium to par. This is different than public convertibles. In public deals, you'll rarely see early investor put rights. Last point on this page, the coupons in a private convertible often can be paid in cash, in kind, or a combination. This is also different from a public deal. Public deals almost always have the coupon payable in cash. Next slide, please. In a public convertible, the conversion price is almost always set off of the stock price at market close after a day of public marketing. Private convertibles are very different. There is no public marketing. So the conversion price can be based on the last trade or can be set off of an average of the VWAP over a period of time. And this period can be 3 days, 5 days, 10 days, 20 days, whatever the issuer and the investor agree on. One point I wanted to highlight. If you sign a term sheet with a 30% premium to the 10-day average before closing, and then you announce the deal and stock jumps 20% upon announcement, you can bet that the investor will come back to you and will want to renegotiate the deal. So it's very important to think through these dynamics ahead of time. The next couple of features are generally used in situations where the investors have a lot of pricing power and negotiating leverage. One is a conversion price reset. This reset can happen based on a preset observation period after the deal. So sometimes you'll see 9 to 12 months after the closing of the deal. And during this observation period, if the average stock price is below a preset price, the conversion price gets adjusted downward. You will sometimes see this in de-SPAC convert pipes. This is a really negative structure, and we recommend clients to move away from this to the extent possible. The other investor-friendly feature is warrants. The warrant strike, maturity, warrant ratio per conversion shares, those are the key sub-features that are highly negotiated. And warrants can have real negative ramifications, dilution, overhang on stock, incremental shorting in the future. So to the extent possible, avoid this as well. And if you must have warrants, try to structure these with flexible or cash settlement so that you at least have the right to get some cash when the warrants eventually get exercised. In terms of anti-dilution adjustments, some private converts follow the public market standards. So conversion ratio adjustment in the event of a dividend increase, asset distribution, spin-offs, etc. But then there are some private deals that include incremental investor protection. One example is a conversion price adjustment in the event of a dilutive capital raise. This adjustment can come in the form of full ratchet. So you issue stock in the future at X, you have to reset the conversion price to that same equity issuance price X. Or it can also be partial based on a formula. So the formula looks at how far below the preset threshold you issued equity, what size equity you issued at a percentage of market cap, and based on that, the conversion price gets adjusted downward. Last 2 points on this slide. Most private convertible preferreds include voting rights on an as converted basis, and depending on the size of the deal, particularly if there is one large investor, often a PE firm, they'll ask for board seats commensurate with the size of the equity stake. Next slide, please. I'll go through this slide quickly, but in private converts, you sometimes see transfer and hedging restrictions for a period of time. And I want to mention that PE firms generally would want to carve out in the hedging restriction so that they're allowed to pledge the convertible to banks in exchange for a margin loan. This is because many PE firms now generate additional funding by getting a loan against their convertible or equity positions. But the good news is that they're not going to delta hedge the convertible by shorting shares. Change of control treatment is very standard in public deals. You either get par in cash or you can get shares at a higher conversion rate, which includes make-whole shares. A private deal may have similar provisions, but we have also seen deals with other provisions. For example, a premium redemption that guarantees a minimum IRR upon a change of control. This totally depends on what the investor is looking for. And lastly, private converts can have covenants like limitations on asset sales and corporate transactions. They often have registration rights and also standstill agreement. Next slide, please. Okay, now that we are up to speed on various features of a private convertible, we'll discuss the 4 key aspects of a private deal that will be useful for you. First topic, how do you come up with private convertible sizing and pricing? So you have heard this a number of times already. For a public deal, there are standard rules. Private convertible numbers, on the other hand, can be all over the place. The same is true for sizing and pricing. We thought we would illustrate this by showing the sizing rules for a public convertible and then compared those rules side by side to one of our recent private deals. So for public deals, the 3 key technical sizing rules are: you shouldn't do a deal more than 20% of market cap. You shouldn't do a deal more than, say, 20 days average daily trading volume. And you should not do a deal more than 2 times your stock borrow. And then this private deal I'm talking about, our recent deal, this was 40% of market cap, 70 times ADTV, and 90 times borrow. So what this tells us is that in many cases, private deal sizes are rather a function of investors' willingness to deploy capital and issuers' need for capital and willingness to incur dilution. Now, if you're dealing with purely financial investors, so not strategic investors and not PE firms and family offices, but let's say a hedge fund, the sizing does tend to tie out closely to the public numbers and the public rules we talked about. Next slide, please. Let's talk about pricing. As you know, a convertible is a combination of a bond and an option. So valuing the convertible requires valuing the bond component using the company's debt rate and valuing the option component using the company's expected equity volatility. What we advisors and bankers do is we first come up with a fair credit spread and volatility pair, and then we find a range of coupon and conversion premiums so that the total package is worth, say, 100 to 104% of par. You then market the deal, and let's say that the deal price is at midpoint, so the convertible price is at a value of 102. That means that the investors buy the bonds for $100, they get $102 of value and capture 2 points of new issue cheapness. Next slide, please. Private investors can use a convertible model, and if they do, sometimes they ask for a cheaper security. So instead of 102, 103, 104, they will ask for 110 to 120% of theoretical value, so 10 to 20 points of cheapness. But in many cases, they can also use other methodologies. For example, a PE firm or an equity investor can do a deeper dive on equity valuation and then run IRR or MOIC calculations based on future expectations around multiples and growth rates and margins. And if they like the story and the valuation and what their model is saying, they may throw the convertible model out the window. So what are the practical implications then for issuers? Number one, as a starting point, the incremental cheapness means that coupon on a private deal theoretically should be 1 to 3% higher versus a public deal. However, number two, terms can vary significantly based on the motivation of the investor. This is a phenomenon that's totally different than the public market. In the public market, talk to any convertible banker worth his or her salt, and he or she should be able to give you a 0.5% coupon range and a 5% conversion premium range with, I would say, 98% accuracy. With private converts, think about a scenario where the equity is undervalued and a blue chip investor is really motivated. In that case, you may get really, really attractive terms. On the other hand, if the market is weak, stock technicals are challenged, there's no PE or strategic bid, the financial investors can ask for terms where the coupon is double than this prior scenario. Number three, what this also means is that the tentative terms you will see from banks will be quite illustrative and generic. For example, you may see a term sheet that says, quote unquote, 6 to 8% coupon or mid to high single digit coupon. In reality, that could mean 5%, that could mean 10%, it can mean 12%. So take these numbers with a grain of salt. And lastly, a private deal is set off of the unaffected stock price. So while the headline terms might be worse, the all-in terms could still be attractive. Let's dig into this a little bit more. This is the second aspect of a private convertible we'll cover. Next slide, please. So a public convertible is generally priced off of the stock price upon 1 day of marketing, and the stock price during this marketing period tends to be down. Part of the reason behind the stock price impact is delta hedging. Hedge funds purchase convertibles to monetize equity volatility, and to do this, they need to hedge their equity exposure by shorting shares. The shorting from a deal equals size of the deal times hedge fund allocation times delta percentage. So let's say you have a $100 deal. If half the deal goes to long-only investors and half goes to hedge funds, and if delta is 50%, then day one expected shorting is 100 times 50% hedge fund allocation times 50% delta, so $25. This is the amount that will be shorted in the market unless the company chooses to buy these shares concurrently with the convertible, or the company chooses to execute a call spread. And the shorting impacts the stock price ahead of deal pricing. In a private deal, the conversion price is priced off of the unaffected stock price because there is no public marketing. So the effective conversion price could be better. Next slide, please. Let's take a look at an illustrative example where a company is issuing a private deal with a 5% coupon and a 30% premium. Stock price is $100. There is no stock price impact, so the conversion price is $130. Now imagine that the same company can also execute a public deal. Let's say that the coupon is 3%, so that's 2% better coupon. But during the 1 day marketing period, illustratively, stock goes down 15%. So the $100 stock goes to $85. A 30% premium on 85 is $110.50, or a 10.5% conversion premium over the unaffected stock price of $100. So in this case, the effective conversion premium is about 20% lower in a public deal versus the private deal. We know that a rule of thumb is that 1% coupon is worth about 10% conversion premium. So what this means is that in this particular illustrative example, both sets of terms have similar economic value. Lastly, the announcement of a private deal, after the announcement of a private deal, depending on the quality of the investors and the attractiveness of the deal, you can see stock going up. But if the deal is perceived negatively, stock can also go down significantly. We spend a lot of time on this particular topic with clients as they think about a private versus public deal.
The third aspect of a private convertible we want to cover is the timeline. For this, we have shown both a regular public convertible as well as a private convertible so that we can compare and contrast the two processes. From the beginning to end, a public deal can be easily completed in 3 weeks. In fact, it is entirely possible to do a publicly marketed convertible deal in 2 weeks, and even less if the data room and diligence are well prepared and readily accessible, and the issuer has had those necessary conversations around deal structure, call spread, settlement methods, share repurchase, change of control, and syndicate structure way ahead of time. If you ask Raj, he will tell you that the fastest he has done a convertible is in 72 hours, although it was for a repeat issuer. The point is that the public convertible process is fast, and the actual marketing takes 1 day, unless there's a 1 to 2 days of incremental wall cross for esoteric reasons. For private converts, the path is less streamlined. If there are reverse inquiry from an investor that is intimately familiar with the issuer, if there's no formal marketing, and if the diligence step is shortened or skipped, the timing can still take 4 weeks due to back and forth on structure and terms. If there's no reverse inquiry, the process takes longer, 6 to 8 weeks or even more. Let's walk through a private convertible timeline where there's no reverse inquiry and there's a real marketing process. The first step is to prepare the marketing material, data room, and decide which investors will be targeted. The next step is for the banks to go to an investor and open the lines of communication under an NDA. Set up meetings, receive feedback, and ideally terms, and start analyzing the results of the conversations. This stage alone takes 2 to 4 weeks. Once investors are finalized, the execution stage begins with the final negotiation. It is very important to remember that even if the term sheet is signed, the terms are not binding, and therefore, even during this stage, things can change a lot depending on market and individual company condition. As we mentioned before, the timing and the nature of the process leads to much more uncertainty versus a public process. Once everything is finalized and signed, the post-closing steps begin. Next page, please. And lastly, as we mentioned, the universe of private investors is highly diverse. Different investor types have different objectives and fund mandates, and so the terms you may get from one group can vastly differ versus terms you get from another group. Well, we show 5 buckets of investors. On the left side of the page, you see strategic long-term partners, and as you move to the right, you see financial players who have different motivations. It is important to note that if you're running a marketing process, it is rare to get invested for the first 2 buckets, unless you already have pre-existing relationships. So let's go through them. In the first bucket, we have strategic investors. They're often a larger company that is interested in building a new business relationship or enhancing an existing partnership. These investors can sometimes offer fairly attractive terms because business terms and partnership agreements may be more important than straight financial terms. The blue chips real money investors, such as sovereign wealth funds, private equity firms, and family offices, are focused on the long-term equity story. They care about the equity valuation and take a long-term view. So sometimes they can also offer fairly attractive terms. Think about a situation where stock was 100 and now after the market decline, stock is at 40. If a fund invests in a convertible at 25% premium and stocks returns to 100 in 5 years, they capture 50% IRR. Having a coupon of 2% versus 3% is less important than to be able to deploy a large amount of capital at the right valuation. However, because of this reason, it is difficult to get them moving quickly unless you're already familiar with the story and ideally are an existing investor. Other equity investors also make for a good partner. They often seek to increase equity ownership with downside protection. And we worked on a deal for 2U recently where a top equity investor invested in a large new convertible bond. Credit investors are an interesting addition to the scope of private convertible investors. They're newer to the landscape. Their requirements and considerations are different versus others. We've had a number of recent conversations where credit investors will look at convertibles as long as the yield is high enough and they're open to high conversion premiums because their equity upside is a nice to have, not a must have for them. Lastly, There are the traditional financial investors, such as convertible funds, multi-strategy hedge funds, special situation investors. They will be highly focused on the bottom line terms and downside risk reduction provisions. We will see a few of these work through the precedent transactions coming up in a few slides. Next page, please. Let's synthesize some of the topics we covered and see where a private convertible makes the most sense. While private convertibles can provide benefits versus a public convertible, the process is long and execution risk is high. Therefore, private convertibles should be a tactical tool in your toolkit used only in specific circumstances. First is when there's a reverse inquiry from a halo or strategic investor. If you have a capital need and you're comfortable with the potential dilutions, you like the overall private terms, that is, both the headline terms as well as any stock price impact benefits as compared to the overall public terms, and you value the halo effect, this is a great deal to consider. Second is when there's a special situation that requires financing, but public marketing is not possible due to the complexity and confidentiality around the transaction. Convertible terms may be more expensive in these situations, but investors may give credit to the positive news and appreciate the downside protection when writing a check. Unity's $1 billion convertible to fund its acquisition of IronSource, an example of one such transaction. The last situation is one where many smaller market cap companies, including some of the newly de-SPACed issuers, fall into, where the stock technicals are challenging. For example, perhaps the company has no stock bar to execute a public deal. In these situations, the terms are likely to be materially worse than what would be available in a normalized public deal, but at least you're likely to raise capital. A sizable portion of private convertible deals nowadays come from this bucket. I'll now turn it over to Raj to go through a few examples.
Thank you, Anna. And next slide, please. On slide 20, we have shown 5 recent private convertible deals that had different types of investors, and the circumstances were different based on the 3 buckets we just discussed. The first one, Septon, had a Japanese strategic investor. This was actually one of the deals we advised on, and in this case, Septon raised almost 40% of their market cap in a perpetual convertible preferred security with a low single-digit coupon. Pretty amazing terms, which show that a motivated strategic investor focused on the long-term partnership can provide really a really attractive deal. Second one was Unity that Anna just mentioned. This is where they announced a major acquisition, and due to the confidential nature of the transaction, plus the willingness to demonstrate that their 2 largest shareholders were supportive of the transaction, they got $1 billion private convert from Silver Lake and Sequoia. The terms were not dissimilar from a public deal when you take into account the stock price impact from the M&A announcement. So stock was down 18% from the M&A announcement, and a 23% conversion premium immediately became, I think, something like a 49% premium. Next one is 2U. We just advised on this deal a couple of weeks ago. This is an example of a large equity investor increasing their ownership because of their belief in the equity story. The terms here were also pretty attractive, particularly when you take into account that the deal had a 42% premium to the unaffected stock price. In general, similar sized deals in 2020 saw high teens % negative stock price impact. You can see that the investors and the market liked the deal, and stock was up 14% upon announcement. Let's skip ChargePoint because we'll discuss a couple of deals by credit investors in the pre-IPO section, and let's talk about Rockley. So Rockley is a good example of purely financial players and hedge funds investing in a company where the stock technicals are challenging and market is challenging. And you can see in this case that the coupon was quite high here, and it was a secured deal, and the convertible came with 1x warrants. So 1 warrant for every underlying share. So in summary, different types of investors and different types of circumstances can result in significantly better or worse private terms versus a normal public deal where terms are much more standardized. Next slide, please. Now that we have covered private convertibles for public companies, we wanted to spend a few minutes on private convertibles for private pre-IPO companies. Historically, there weren't a ton of pre-IPO convertibles in our market. We would see 1 or 2 deals a year here and there. But in 2015, Uber did a sizable pre-IPO convertible, which put this structure on people's radar. Since then, we have seen a handful of pre-IPO deals every year. In the last year, given the IPO window has been closed, many late-stage private companies have been waiting on the sidelines, and with valuations down, they have been reluctant to do a Series F or Series G in a down round. So these companies are now looking at the pre-IPO structure, and there have been a couple of interesting deals recently. So what is a pre-IPO convertible? A pre-IPO convertible is a bond or a preferred security that's issued by a private, oftentimes late-stage pre-IPO company that can be converted into equity in the future. Generally, companies consider a pre-IPO convertible if they are considering an IPO in the near to medium term, and this is really their last financing round before an IPO. A pre-IPO convertible has several benefits: issuing equity at a premium, avoiding a down round, deferring any valuation conversations. But it's also complex, and it can be particularly costly if you delay your IPO. Who invests in pre-IPO convertibles? Existing investors, sometimes multi-strategy funds, some real money players, crossover players, and most recently, a handful of credit funds. Next slide, please. There are a number of variations in a pre-IPO convertible, and today we'll cover the 2 major types. Historically, the pre-IPO convertibles were structured so that they would get automatically converted at the time of the IPO, often at a discount to the IPO price. That's the first structure, the auto conversion structure. In recent months, we have seen a newer second structure where the pre-IPO convertible survives the IPO and becomes a real convertible at IPO time. The first structure is simpler, but you have to be careful around how it might impact IPO demand. And the second structure allows you to get to a higher equity price, and they can be structured to appeal to credit investors, but this is more complex. And post-IPO, if there is any delta hedging, that can impact your stock price. The Arctic Wolf deal that Morgan Stanley did in October is the first sizable deal of this variation. And we are talking to a number of companies that are thinking about this structure. Next slide, please. So let's talk about the key provisions in a pre-IPO convertible. Historically, pre-IPO converts used to have a low to mid-single-digit coupon. But with increase in rates in today's market, investors are now demanding a higher coupon. Coupon here is often structured as PIK because the issuers are often high growth private companies. On the conversion premium side, the automatic conversion structure comes with a 10 to 30% discount to the IPO price and can have a valuation cap. And then in the premium conversion security version 2, the conversion price can be set at a 10 to 30% premium to the IPO price. Arctic Wolf had a quote unquote lower off provision. So the conversion price is the lower off a premium to the last valuation round and a 25% premium to the IPO price. Effectively, it's a 25% premium to the IPO price subject to a valuation cap. In terms of maturity, these deals often have a 4 or 5 year tenor. And you will also see ratchet provisions in these securities that are tied to expected IPO timing. So for example, if you don't do your IPO within a preset time, like 6 months, 12 months, 18 months, coupon can decrease, coupon can increase, discount can increase, and conversion price can decrease. Next slide, please. Pre-IPO securities also can have premium redemption features. So if you don't do an IPO, the investor may want to capture a sizable debt-like IRR through a premium redemption. And even if you do an IPO in the Arctic Wolf structure, the investors have a redemption right at 145% of par in 4 years. So that guarantees them a 10% yield from that particular feature alone. I won't get into the details of the relationship between premium redemption pick and conversion price, but I did want to highlight that you can structure the deal to get to a higher conversion premium by playing with these features. Lastly, you should be careful around the definition of a qualified initial public offering. It should cover IPOs, direct listings, business combinations, C-SPACs, everything. Now, investors in turn will probably ask for a minimum IPO size and can ask for a minimum IPO valuation for the definition of a qualified initial public offering. Anna, do you want to cover a few of the legal considerations of pre-IPO convertibles?
Sure. I'm gonna go ahead, just given the time rush, and just take it from here to the end. So on the legal considerations, as Raj discussed, more and more deals are going from private pre-IPO convert to public IPO, to public convert. So the convert is staying around post IPO, and that requires making sure that there's good planning in place at the time of the pre-IPO convert. So making sure that the pre-IPO convert is structured as a mandatory. This is important so that for securities purposes, you can tack. The holder of the pre-IPO wants to tack for Rule 144 purposes back to begin its holding period from when it purchased the pre-IPO convert, and not have a new holding period commence when the company consummates the public offering and the security flips from the pre-IPO convert to the 144A style convert. Another important issue to contemplate early on is the clearance and settlement discussion. So pre-IPO converts can be structured along the lines of what Raj and Anna were talking about as private converts. So is Section 482 privates. And that would mean that they would not settle through DTC, they would settle physical. However, that can be a real impediment if the convert is intended to stay around and really transition to be a 144A style convert. So technically, what you really would like to do is make sure that you document this through an indenture, which is the next point, instead of using a note purchase agreement, and that you have a trustee that agrees to act as a settlement agent, or alternatively, that the bank that you're using acts as a placement agent, and then that you have the transaction treated as a 144A qualifying transaction, since the buyers are themselves quibs, and settle the pre-IPO convert through DTC, and then move it over to a new CUSIP when it transitions, when the company does consummate its IPO. Some other things in terms of going from pre-IPO convert to post-IPO convert. In a number of the pre-IPO converts, there are more onerous terms that fall away in a traditional 144A convert. For example, in some of the pre-IPO converts, it's relatively common to have subsidiary guarantors and collateral. So it's important to plan for how those are going to get released. The liens are going to get released on the consummation of the IPO. Generally, you won't have any subsidiary guarantors. If you continue on with the 144A convert, you don't want to have subsidiary guarantors, because that just is going to introduce more complexity from a financial reporting perspective. If you have negative covenants, you want to make sure that those fall away upon completion of the IPO. Next slide. The public company, in conjunction with the IPO, is going to file an EDGAR, the indenture, and all the related documents. You want to make sure that those are negotiated at the time of the pre-IPO convert when that's done, so that everything is ready to be filed on EDGAR. And then governance rights. So usually the pre-IPO convert holders will want some type of observer right, information right. That can be tricky. You will want the observer right to fall away upon the consummation of the IPO. You'll want the information rights to fall away because you don't want them to be insiders in a public company and create issues regarding access to material non-public information. So all of that has to be thought through. On the next slide, and let's turn to it, we have some examples of terms. Okay, we'll go right into structured debt and non-convertible preferred. So as I mentioned at the outset, this is a time in the cycle where we're seeing interest from private equity funds, from credit funds in investing, and generally they're more interested in investing in instruments that are more debt-like. And so if they're not looking for a convert, they may be more interested in a non-convertible preferred stock. So preferred stock that is very debt-like. It will bear a coupon, have a guaranteed rate of return and a term. Depending on, these are all fairly bespoke securities, depending on the terms of the security, they can be so debt-like, even though they're termed equity, that they can be for debt, for accounting purposes, they can be debt on the issuer's balance sheet, which may be problematic from a covenant perspective. And they might also be debt for tax purposes. So depending on what the issuer is looking to achieve, it's going to be important to look holistically at all of the proposed terms of a non-convertible preferred and assess whether for accounting and tax purposes, the security, when looked at as a whole, would be debt for tax and debt for accounting purposes. The term usually would be 5 to 7 years, with some ability on the issuer's part to prepay, usually after a non-call period or after the investor has achieved a specified guaranteed rate of return. It's going to be senior to all common and to all junior preferred. Generally, there'll be limitations on the issuer's ability to incur additional debt, or will negotiate buckets for permissible debt incurrence. Will generally negotiate a fundamental change provision, very much along the lines of what you would see in your typical convert. Financial covenants, these are going to be highly dependent on the issuer, the industry, and the conditions of the issuer. There will generally be a warrant that will accompany the preferred. So the warrant is going to give more of an equity-like upside. On the next slide, we talk a little bit about the warrant terms. So the warrant that provides the equity kicker will also have highly negotiated terms. So generally will provide for automatic exercise on a company sale, or a fundamental change formulation. For a private company, automatic exercise on an IPO so that the warrant isn't hanging out there. Anti-dilution provisions are typically going to be fairly broad-based, so not full ratchet provisions. Transfer provisions, in the case of private companies, you may need to think about existing investor rights agreements that are in place. Preemptive rights to participate in future equity or debt rounds, redemption rights. You may see some redemption rights, which again may have the effect of making the warrants a little bit more like a liability and may trigger bifurcated treatment for accounting purposes, or may make the warrant itself a debt instrument for accounting purposes. So they may only be redeemable upon certain the occurrence of certain events, or only redeemable upon the occurrence of liquidity events. The next slide. The warrant may be in place in effect to provide an opportunity for investors to negotiate governance rights, and generally what we'll see is just observer rights, typically no director rights. And usually the observer rights themselves will be pretty limited, only to circumstances where the holder owns a certain percentage of the warrants that were purchased in the transaction, or a certain percentage of the underlying securities, the common or other securities that the warrants are exercisable for. Lastly, in the couple of minutes that remain, I want to get to structured debt. This is mostly in the case of private credit funds, although we do see this as well with other private equity investors. Again, more appropriate in this time in terms of where we are in the market cycle. This could be a straight debt security, in which case it would have a lot of the same types of features that I just described in the context of discussing the straight preferred. And that would also be accompanied by the warrant. Or you might see first lien or second lien notes. Those generally would have a typical maturity of 5 years, bearing cash interest, sometimes with a PIK feature. If you have a PIK, the PIK might be only partial. This might be a redeemable instrument where you have some redemption. Either you see redemption in full if the investor is guaranteed a certain rate of return, or you might see redemption only subject to payment of a make-whole premium. Also, these generally include fundamental change provisions. And then finally, next slide. In the context of these first or second lien notes, you'll see a security package. So a guarantee and collateral. Again, this is very much dependent on the issuer, the industry, and the circumstances, and often will involve having to negotiate an intercreditor agreement to the extent that the issuer already has an existing credit facility. And in the context of trying to think about a guarantee who you're going to be looking for guarantees from, we typically look at the borrowers on the issuer's credit agreement, as well as maybe looking at the outstanding debt that the issuer has out. The covenants very dependent on the issuer. On the whole, depending on the rating, we'll probably only see some negative covenants. So that gives you a little bit of a flavor for what we're seeing on the structured debt, straight preferred and warrant side to complete the picture that Raj and Anna presented for private converts, public converts, and pre-IPO converts. Thank you very much all for joining us. We appreciate your time. If you have any questions, I'm sure that Anna and Raj would be very happy to take those and answer them later. So you have their contact information there. Any of your Mayor Brown contacts would be happy to answer questions as they come up. And I'm sure that we will see lots of interesting and creative structures as market developments continue to pose challenges. So thank you, and wish you all a good weekend.